Hello guys, welcome to my YouTube channel. I am Adugbiri Emmanuel Lordsmith, right? And today I'll be taking you through a trade breakdown on how you can catch reversal trades. But mind you, reversal trades are very risky and it shouldn't be traded blindly, right? As a trader who wants to trade maybe both in the continuous trade and the reversal trade, you should have a back-tested data, a backup data that tells you that yes, at this point of the market is ready to reverse in other styles, right? So I'll be taking you to 4 key things to know when taking reversal trades, right? I'll be taking you through 4 things to know when taking reversal trades. My network is bad, yeah, so it's back. So I'll be taking you through 4 things. Let's move down to there. Let me show you these 4 things you should note when you want to take reversal trade. So the first one, we'll talk about structure. As a trader, you need to know market structure. It's very important. If you don't know how market is moving and how the market is reacting, whether it's reacting from an internal range liquidity to an external range liquidity or not, then you will not be able to catch reversals, or you'll be trading blindly, which is gambling, right? So you should know, firstly, you should know what structure is. When you open your chart, you should be able to mark your structure well. Being it in an uptrend, you should be able to mark your swing highs and your swing lows, right? Consistently, right? And being it in a downtrend too, you should be able to know how to spot structure very well. And mind me, this is just the basic structure that I'm marking, right? In the advanced structure, you will see something like this, then again to the downside, maybe taking out this internal high, right? So the first thing you should note if you want to be able to catch reversal is know how to mark your structure very well, right? So the second one is going to be the type of reversals, maybe so on. So this type of reversal are when market is in, so the first one we have here is internal range to external range. So for example, when we have something like this, let's assume you have a break of structure. Now market has come back to an internal, so if you want to catch a reversal here, you see something like this, then sweep into your point of interest, right? Then you have a market structure shift. This is a reversal, right? So market is reacting from an internal range liquidity and now targeting the what? External range liquidity. So at this particular time, this is the what? Internal range liquidity to external range liquidity reversal, right? Because market is reacting from what? An internal range liquidity and targeting this high, which is an external range liquidity, right? So in this case, this is the type of reversal that we'll talk about first, right? And also the external range liquidity to an internal range liquidity. Also know that when market takes out this external range liquidity, market will not keep moving to the upside, right? It will need to pull back into an internal range liquidity. Before it continues. So this kind of reversal too is also called the what? External range liquidity to internal, because market is now from an external range liquidity now pulling back to an internal range liquidity. So in this case, you see market doing something like, so let me just assume here, you see market doing something like this, either creating a swing high, then giving us market structure shift, then now back to your internal range liquidity. So which is what? External range liquidity to internal range liquidity, and again it will repeat the cycle that just did here. From internal range liquidity, it will move back to what? An external range liquidity. And this is how the market moves, right? At the beginning, if you even know what structure is, you know that the market moves from external range liquidity to internal, internal. And if you should ask what are external range liquidity, they are the all highs and all lows, right? And internal range liquidity is anything between the all high and the all low. It's like more like a range, right? So it can be your order block, it can be your fair value gap, any of your point of interest is your what? Internal range liquidity. So this, let me mark this. So this is an all high that was taken, and this was the low. Let me put it here. All right, let me put it in, and this was the low, right? So now anything inside here, it's what? Internal range liquidity, being it your fair value gap. Firstly, we always have the ICT PDRs, being it your breaker block, being it your fair value gap, or your other block, right? So these things are what? Our internal range liquidity. So when market takes out this all high, which is external range liquidity, to pull back to mitigate an internal range liquidity before it takes out this external range liquidity, right? So you need to also know that if you are able to know that and you open your chart, you will be able to identify, okay, where is market reacting? Has market taken an external range liquidity? If yes, so we are now looking to take a reversal into your what? Internal range liquidity. But mind you too, reversal trades are more like we are stealing. So if you are a newbie, just like I said, always stay out of reversal trades and wait for the main trades to join, which is what? Always safe. But if you've backtested your edge or your trading strategy to a point that you have a data that can back it up that yes, you have a edge that can help you get a reversal trace at any point, then that's fine. But if you're a newbie, pay more attention. When you're able to identify your structure that the market is bullish, wait for market to come to these zones, then you buy. And if it takes the external range liquidity, don't look to sell and buy. No, always wait for market to come to what? Your internal range liquidity, since you've established your bias and your structure. Now that's it for the what? The two types of reversals. The first one we said internal range liquidity to external range liquidity, and the second one is when market take this, now it will need to pull back to what? The internal. So that one is external range liquidity to internal range liquidity. So now let's talk about the number 3, right, which is reversals happening from POIs. Reversal happening from POIs. Now just like we did this example, let's assume you had a break of structure to the upside, right? Then we have, this is our boss, break of structure, and this is our POI. So I'm using other block in this case, right? Now this reversal is going to happen from when market is coming back here. This reversal is going to happen from what? A key level, right? This reversal is going to happen from a key level. You get me? It's going to happen from what? A point of interest. This reversal is going to happen from a point of interest. But whenever market takes out an external range liquidity, usually at all-time highs, the BTC trade I took, now I'll tell you, market wasn't reacting from any point of interest. If you look at, because market was at the all-time high, so it wasn't reacting from any point of interest, right? So at that moment, it's always risky because market is not reacting from any key level. But in this case, market is reacting from what? A key level or a point of interest, right? So just like I said, reversal happening from what? A POI. So in this case, market is happening from what? A key level. But in the case that there is no any POI at the left, when you trace back, you see taking this kind of reversal is going to be risky because market is at the all-time high and you are looking to what? Short. When the market is at the all-time high, it's very good to short, but it's also risky, right? So you just need to have a backup edge or data that tells you more about that. So let's see if you can do this more about it, right? Yo, minute less yeah. So let's see. Sorry guys, yeah. So what was that? I'm sorry guys. Yeah. So when market is not reacting from a what? So that was the second one. The second one too, so a reversal happening from no POI. So that is the one I'm talking about. When you trace back, you don't see any point of interest at the left side, and but then market has taken out what? An external range liquidity and needs to pull back, but it's not reacting from anything, right? Market might just do something like this and react from this breaker block and continue, but you were looking to what? Sell to an internal range liquidity, which also this breaker block is an internal range liquidity. Market will react from it and buy. So these are key things you have to note. Reversal happening from POIs are always secure, or let me say, are always safe, right? Because you know it's reacting from your point of interest. You wait for your liquidity to sit, market structure shift, then you buy to the external range liquidity. But when market takes out an external range liquidity like this and it's not reacting from any point of interest and you need to take a reversal trade, you need to be careful, right? I guess this one is okay. Now let's talk about the fourth one, which is what? The swing high reversal. So what is the swing high reversal? It's more like something like this. When market breaks structure, so taking it from an internal, this is our point of interest. You see market coming, then we have a sweep of liquidity before the what? Market structure shift. Then market comes back before buying. So this is what we mean. I mean by what? A swing high reversal. A swing high reversal. So now you see that market, before market got to your point of interest, we have something like liquidity here. The market swept it before giving. So this is a protected low. In this case, it was able to sweep out, do its job by taking out this low, right? So that is what? A swing high reversal or a swing point reversal. Anyway, don't just focus on the names, right? You can call it any name, but just understand the logic behind it. And this is the second one, which is also the last one, which is also the failure swing. So the failure swing is always more like a mitigation block formation. This is like a breaker block formation, but this is more like a mitigation block formation, something like this. You have a break of structure, so market will come to your point of interest, then we have something like this. Then market fails to take out this low, stop here, then breaks, change character and start moving in your direction. In this example, you see that market, this is your point of interest, this is your point of interest. In this case, we can see that market has failed. In the first example, market was able to sweep out this low before touching into your point of interest. So this is a protected low. But in this case, market was not able to sweep it out. It failed. This leg, this price leg, this swing leg failed to take out this low, right? And we had a market structure shift to the upside. So in this case, it's a failure swing reversal. So you need to know all those things before you start to take reversals. I guess this was helpful. So let's get onto the chart. Let me break down how I was able to take that BTC cells from an external range liquidity to an internal range liquidity reversal. So with a swing high reversal. It wasn't reacting from any point of interest, right? So let's get it in. So now this is it, right? If you look at BTC currently, BTC has been trending upward from here, right? BTC started trading upwardly. Sorry guys. Yeah, BTC started trading upwardly from here. You can see that structure here is just showing bullish, right? Structure is showing bullish here. So now what was I looking at? I was looking, so let me mark this. This is a break of structure. This is a break of structure. Another break of structure. I don't want to do top-down analysis here, right? I just want to, this another this is not a break of structure, this is sweep of liquidity. So now this was the pattern I was talking about. So let me read down it. When market takes out an external range liquidity, when market takes out an external range liquidity, it needs to pull back to an internal range liquidity. So immediately I saw market taking out this high. Let me draw that. Let me zoom in. So immediately I saw price taking out this external range liquidity. I said to myself, okay, then market will need to pull back to an internal range liquidity, which is there was liquidity here and there was liquidity here. And mind you, I kept my target here. So let me show you the before. I sent it to the Telegram channel. Let me show you the before of the trade, right? Let me show you. So BTC. All right, so this was it. This was the before of the trade. So you could see the market took out the external range liquidity. Then I was now looking to trade into an internal range liquidity, and this was where my another point of interest that I will be looking to buy from, and this was the liquidity I was what targeting. So I was targeting this liquidity. So look at it. So when market took out the external range liquidity, I needed to what find an entry to what an internal range liquidity. So I quickly search for this pattern, a swing high formation, something like this. So a break of structure, then I looked for something like this, sweep of liquidity, then change instead of delivering, my entering confirmation. Some you can wait for market structure shift, right? But I use change instead of delivering as my entry model, right? When market goes to my point of interest, I look for sweep of liquidity and change instead of delivering in line with the trend. So this was the pattern I traded, with the logic behind it, knowing that market moves from external range liquidity to internal range liquidity. But it was a risky trade, right? If you check it, when I sent it up to them, I said BTC reversal trade, very risky, because I'm trading against the trend. Yes, because the market was bullish and the market was at the all-time high, so there wasn't any place that market was reacting from. If you trace back, right, because market just took out this, let me go to the 4-hour. You could see that market just took out this external range liquidity, so there was not anything here that market was reacting from at the left side, right? Market was not reacting from any key level at this zone. Market was not reacting from any key level at this zone, so it was very risky. But because my experience in the market made me to understand that yes, no matter, even if market will continue buying to the upside, then you have to have what a pullback into an internal range liquidity before we continue buying, right? So that made me to have the strong conviction to buy this market, right? And mind you, look at market did exactly same. This was the area that I wanted to buy from, right? This was the area and this was my target. This was my target, right? This was my target. And the entry model, just like I said, liquidity sweep, change instead of delivering, then I'll enter. Change instead of delivering, then I'll enter and target the what? My internal range liquidity. So this is my change instead of delivering here. Then I'll enter and target the external range liquidity or internal range liquidity, right? So this is my entry model. So this was the entry model I used. This was the entry model I used, right? Just basic things. Just need to understand structure, need to know where market is coming from and where market will be going. That's just all, right? So immediately I saw that, I went to for 2 hours here and I saw my liquidity sweep. This was it. If you go lower, fine, but if you go to the lower time frame, it's very clear. But I saw it here and I understood that this was a swing high. If you understand that this candlesticks too talks about what, when you have something like this, 3 candlestick formation, that talks about, let me put it this way, so the 3 candlestick formation can be what, a swing high to something like this. Something like this, and you have the wicks, right? The first wick, the second wick. My drawing is very bad, right? And the second wick should be longer more than the first one and the second one. So let me put it that way. So something like this. So a 3 candlestick formation, that the middle wick or the middle candle wick is more than the left one and the right one. So this is a swing high, right? If you use candlestick formation, exactly this was it. You saw that this candle was what, the wick was more than this and this too. So this is a swing high and it's a liquidity sweep on the lower time frame. So when I saw that this was my change instead of delivering, then I entered my trade here. Then I was targeting this liquidity and I was waiting for market to come to what, this zone, so that I could buy, which is this zone, right? Market should come back to this zone that I could buy, right? And if you look at this, was it, you see, this was where I was looking for market to come, then I'll buy. Yeah, so market did same, right? So currently I haven't taken this trade because what I was looking for, I didn't see it, and I left the chart. I came back later and saw that yes, it happened, and this is where it happened. In this case, you have a what, a failure swing change instead of delivering for me, right? So when market got to there, we had this push, no manipulations, we had this push, and let me delay this, and show you. So when market got there, this was the formation, the pattern market gives us. Market taps into my point of interest, and we have something like this, and we had something like this, and market started moving to the upside. So now this is a failure swing for me, and market gave me my failure swing change instead of delivering. So this is it. This is where I should have entered if I was on the chart. At this moment I wasn't on the chart. This is it, this, right? This was my entering point, failure swing change instead of delivering for me, and my stop loss below here, or below the candle that broke past, that broke past my series of down close candles, right? So something like this, it's not bad, and you can target, because you're already bullish, you can target the what, the external range liquidity. But normally I go for 1:3, 1:5. I don't overdo, right? 1:3 and 1:5, I'm good and I'm done for the market, right? So I can target here. This is a key level too, right? So I can target here, then when market gets there, then I'm out, or maybe target this high, then I'm out, 1:5, right? So that's just it, guys. Pay more attention on knowing these 4 things. If you're able to know these 4 things, then I know, or let me say, with the help of these 4 things, you'll be able to catch trades knowing the logic behind them and not just trading them blindly, right? So guys, I hope this video was helpful. If you do like this video, consider subscribing. I'm documenting my trading journey here as a forex trader, an upcoming millionaire forex trader, right? So consider subscribing to my YouTube channel. Let's grow together. Stay blessed. See you in the next video.